if you look at, if you look at, I'm going to spend some customer types too after this presentation, but I'm going to spend some time on digital asset types. We spent a lot of time in the past few days on a lot of things happening, but there's a classification system that's emerging. And we'll spend some time in what the classification system is. It helps you make sense of this crazy world. Because not all tokens, and after this short session, we'll take a 5-minute break, and please remind me for lunch today. I completely forgot about this yesterday. We'll break at 1 o'clock, I think. And then I will walk through a real life scenario of how I built a portfolio, which is more interesting. So let's understand the classification, then I'll walk through my journey and challenges that I'd go through. And now we're at the path, and now we're using AI and machine learning actively to be able to go through this process. So digital asset growth has been, I don't have to go through these numbers. I think we've seen a massive growth from the perspective of the fact that there are close to 10,000 digital assets. My count is 15,800 plus tradable digital assets. And this is interesting because many of these are from the exchanges, and exchanges have become the primary source of data. But I think there are a lot of these who are not on traditional exchanges, but there are many of these coins who are emerging, which is either in private equity space, which, by the way, how many are familiar with private equity models here? Private equity, basically you raise money in private, you're not in the public, and you invest it. So go ahead, sorry.
So basically there are two types, like in traditional finance as well, you can do either an IPO, which is like an ICO, and either you can raise money from venture capital, any of the people who are rich and are willing to invest in your project. So that.
Right, and if you want to go IPO, then you're public, right? The whole idea is private equity takes the early seed, early risk and reward ratios when I take the risk. And the moment you go IPO, I reap the rewards of my risk. And oftentimes that journey can be 5, 6, 7, 10 years. The new model that we see in crypto space, which is why I think a part of this focus is the entire investment space has shrunk. What used to be a 10-year journey is now the fact that you invest in these projects, the project launched their coins, they have some level of success and list the coin on exchanges, and the private equity company or VC firms who had to wait for 5, 6, 10 years, they can suddenly now liquidate those tokens and they get their returns back in 2 years. So that has, in at least my first-hand experience, has sped up a lot in terms of the investment cycle, which used to be a 7, 10-year journey, good and bad. That's causing all kinds of internal issues in terms of what's real, what's not, because if they're able to sell and exit out, they're offloading the risk to the market, who is people like us who are looking at this like, wow, this looks cool, because A16Z invested into it, but A16 already got paid, and they move on the next project. So what is the risk ratio there? So how do we think about classification? Well, there are a few things, right? Historically, we have gone down this path. We have gone down in terms of functionality, and that's why we use the word cryptocurrency, crypto assets, utility coins, stable coins. We've looked into what's the functionality of an asset, what technical functionality, what it does. Yesterday, we spent a lot of time on layers and token standards. Layer 1, layer 2, layer 3, layer 4, decentralized exchanges, each of those ecosystem, which, by the way, how many layers do we have?
4.
Wow, that is resounding full. And I like that. What is the first layer? No, what's the first layer? Banks? Why would banks be a layer? No, the layer 1 is settlement layer, which is layer 1, like Bitcoin, Ether is layer 1. Layer 2? Polygon. This is like scalability and security. Layer 3? Applications, stable coin. Layer 4? Right, those are the Uber, the aggregators, and so on and so forth. But layer 0 is Web 3.0, the technical people who are providing the technical infrastructures, and you have anywhere between 0 to 5. And that's what we did yesterday. We looked into, and there are token standards. So if you look at the global standard bodies, ISOs, for example, and W3C, for example, there is no really such standard for tokens. I used to be part of something called ISO TC68, which was a technical committee for currency and token standards. It's very, very slow. I mean, I don't know if many of you have been on ISO calls. They're still in like what used to happen a decade ago, still figuring out the classification system. But it was there. What has become more interesting now is legal interpretation. What is a security? What's a debt? What's a currency? What's a payment? So you can imagine the challenge in our world where things were fairly clear in things that we had value. Your house was an asset, and if your house was amortized and sold as a mortgage-backed security, it became a security, and the money that you bought was a lending instrument. So you had all the, or even, for example, collateralized debt, CDS and CDPs. Now, those are legal interpretations. So we are in this melange of all three things coming together, which makes it enormously challenging to say, what is it? Right? So the legal interpretation looks into commodities. So for example, CFTC, which is the entity in the US, has deemed, what is the equivalent of CFTC in India? SEBI. No, it can't be SEBI. SEBI is SEC.
SEBI took the commodities.
Commodities also?
It was FMC earlier.
Okay.
They got merged and SEBI is now.
Got it. So SEBI does both commodities and securities. Wow, that's broad powers. So we have CFTC. CFTC has deemed Ethereum as a commodity, which means they have a broader perspective because they have. So commodities generally has access to a much more broader enforcement access because they have access to all transactions, no matter where they happen in general. SEC has something called digital security. Again, this is where things become interesting for fungible, non-fungible tokens. What is a fungible token? Is it security? Is it, and in many cases, they have begun to look into NFTs so that debate continues from that point of view. And then you have digital consumer assets, fan voting, artwork, collectibles. This is sort of the landscape that we're dealing with. This is important from investment point of view as well. One thing that I have done which I'll show you my portfolio, is I looked into a few things. I had this framework. But I also looked into some of the elements that fact I will not, because we are regulated, we are licensed. This is what we do with Portal Asset Management, not IBM work, is around the fact that we don't want to risk our investors. So we don't want to go into something that's questionable both in terms of security or that actually has a questionable past or questionable founders. So you want to be in the clean, only because that imposes a high risk with any lawsuit or any injunction that you may get from any of the government bodies. So Howey test, how many are familiar with Howey test? It's a simple test that basically tells you what is security, what's not. And to me, it's antiquated. It's like 1939 securities law, which is literally it's 100 years old, almost 90 years old. And I'm thinking why are we still hanging on to that? Because the world has moved on, the way we treat assets has moved on, but we still apply the test. And the objective now is to be able to move away from Howey's test, but it is what it is. From a fact that your investment of money, and by the way, SEBI uses the same framework in terms of discerning between how do you tax your short-term, long-term, the cost basis. These are all calculus that goes into taxing eventually your crypto. Are you going after common enterprise? Is it reasonable expectation of profit and derive of effort of others? Effort of others, miners, stakers. So is it an enterprise? Is DAO an enterprise? It is. Is DAO's token a security? It can be. Is DAO a decentralized infrastructure? So which means if something is truly decentralized, can the government go after you? Yes, everything's for profit. No one's doing this for the betterment of, everybody wants to make money in this. Be under no mistake, everybody wants to make money from this. So everything's for profit. Hold that thought, because we will get back to it. It's a very gray area at the end of the day, because that's the whole debate on holding developers accountable. Well, but then you also have free speech. Writing code is free speech, just like tweeting is free speech. So how do you infringe upon that? That if I'm exercising my right, how can you hold me as me working for somebody else? Especially in the new, what we have seen, I have written about this too, is future of work. How many familiar with Gitcoin here? Gitcoin? Have you heard of Gitcoin? Oh, that's great. So write this down. So Gitcoin basically is the future of work. People post their jobs and they put a bounty on it. You pick up the job, and not just you, but people compete for the job and post their work, and the person who's asked looks at the work and picks the best, and you get paid in Gitcoin. You convert the Gitcoin into Ether or Bitcoin through an exchange, and then convert to banking. That's the future of work, and it has been enormously successful. Developers all around the world don't have to work for anyone, sit in their homes, find the right opportunities that they can do, which is rich enough, and I believe that that's fantastic. Of course, it's still under the radar for taxes and healthcare and other things that the employers provide. But I can see how that transforms the way we work. So in case of Dow can provide those things as a healthcare option for that job. If that lasts for 3 months or whatever, then you could have healthcare as a part of non-fungible token if you accept the job, for example. Fever. Yeah, it's something like that, but that's still a centralized platform. In Gitcoin, you basically post a job and you provide a bounty on, technically it's a centralized platform too, but you're getting paid, not in rupees, but you get a currency in Gitcoin. So if I had to post a job in Gitcoin, I had to buy Gitcoin and then pay in Gitcoin to developers. So it's a systemic currency. It has own coin. If they have own coin, it would be the. So it's in system, in network currency.
And if this is in DAO, if you do a job that's basically that's a terrorist act, then it won't be held accountable.
That's right.
Is Bitcoin a DAO?
No. So Maker is my perfect example. MakerDAI. Have you heard of MakerDAI? It's a collateralized debt position platform, which allows you to collateralize your assets and get DAI, which is a stable coin. And you have to over-collateralize it, and you can take the stable coin and then buy other crypto sort of entities with it. And start out as central, but I think their CEO resigned. So now it's completely a decentralized entity. And we always joked about this when SEC sued Ripple. And we said, if you're decentralized, can they really sue you? Which means you are centralized, and you are sort of, in some cases, maybe not adhering to your regulation because it's a closed network. So even though it's blockchain and your closed network, doesn't make you decentralized. So again, we're not drinking decentralization Kool-Aid, that you can use the technology and still get the benefit from it without calling it decentralized.
XRP doesn't claim to be decentralized.
Who? They do and they don't. So they have Ripple Inc. and Ripple. So Ripple Inc. is the centralized entity and they have the foundation. So the question then becomes it's always shuttled between, it's a foundation doing it, we're just enforcing it. We're a business that's feeding off the foundation. You can't really sue a foundation because the foundation, all they do is technical upkeep of the network. So who do you really go after? So if foundation is keeping the network that's issuing tokens, and they're a technical entity, and they're just upkeeping the infrastructure, and then you become an Inc., and you're managing the onboarding, offboarding of regulated entities, then that's the problem here. That they're going after the XRP, but XRP is issued by the foundation, and somebody else monetizes it. So who really is accountable here? So there's no clear guidelines around this, right? Because how we test applies to one but fails to the other side. By the way, they're looking for VP of engineering if anybody's interested.
How do we differentiate between a digital commodity and consumer asset?
So Ethereum is digital commodity. It's commoditized in terms of, it's a utility that fact I do. So the argument that even while Ether has a lot of value and so does Bitcoin, I do need those native currencies to act natively in that infrastructure. So that's a digital commodity in crypto sense. But you could apply the same principles in other digital ecosystem which are not decentralized or not crypto based. And so I discern between cryptocurrencies, digital fiat, crypto assets. And I think crypto assets are, NFTs could be crypto assets or digital assets. That they are enciphered form of which ascertains your ownership and digital rights that you have to those. That's how I would classify it. So layer one, so we discussed this yesterday. This is the trilemma, security, decentralization, scalability. Shreyas aced this yesterday. Layer one, blockchain protocol attempts to provide some functionality. Layer two. So we have this multiple layers. Layers three again is so this is in line with the thing we were thinking yesterday. We have some token standards. What does ERC stand for again? That's right, ERC. And you have just something RFCs we used to have back in the day for technical standards. And these are not, by the way, these are not global standards. I just want to make sure. These are Ethereum standards, which means they don't apply to other networks. But there are similar standards. And what other standards have done is they've put their sort of moniker outside in front of RC. And they have now Solana request for comments, and they have all the other things. But the conceptual element is the same, that if you want to operate in that ecosystem, there are standards built around the ability for you to create non-fungible tokens. So this whole process of publishing, minting, blocking, and this, I erased it, but these standards give you an avenue to be able to create, mint, disseminate, distribute tokens from that perspective. And these are like, for example, ERC 1555, which is the recent one, is the example that I was giving you, that I can create a content, I can publish it, I can transfer it to you, and I can provide a codified option in it, which says that every time you sell it, I need 5% of it. So when you're buying it, you can agree to those terms, or you can say, no, that is a disadvantage to me, so I'm not going to buy it. So you can see how you're letting market forces decide the value of your art. If it's predatory, then you'll not get the audience that you need or patronage that you need. And that's an important part of some of these standards. The publisher. So good question, right? Niharika asked me about this thing between fungible and non-fungible tokens. The fundamental difference between cryptocurrency and digital asset. So cryptocurrency is a digital asset, but not all digital assets are cryptocurrencies. Get that, right? So cryptocurrencies are generally governed by crypto-economic systems, minting, mining, proof of work, proof of stake, all the things that we discuss in terms of that whole thing. In case of NFTs, somebody has to create the NFTs, tokenize them, and then goes towards layered on top of the transactional layer system, which is blockchain in general. So in case of NFTs, it's creators. And that's why we always focus on creators economy. The creators don't have to worry about layer 1, layer 2. And so places like OpenSeas or Dapper Labs have made it a lot simpler to say, hey, you focus on creation, and we'll give you the infrastructure for you to be able to create a token. And ERC20 is a perfect example to say for fungible tokens that all initial smart contracts allowed you to create ERC20 tokens, which actually had value because they were part of the DAO. So I'm creating a DAO, and I want to have a token economic structure inside of the DAO. So remember, you have layer 1, you have layer 2, and you're creating some economic system, which is lending or borrowing or whatever it is. Then you are creating rules around the token, how many supply of token it is. So you're limiting that in that ecosystem, the closed ecosystem. So these give you an ability to devise a token economic system, but use the underlying blockchain as a transaction system, which means you still need the source of single source of truth and need the token to process these things, but you have your own little world that runs on top.
There'll be too many little worlds on here.
Yeah, you'll have like hundreds of these DAOs who have their own ERC20, ERC17. Yeah, those are token standards.
There's so many token standards with
Yep.
each network.
Yep.
Then there'll be regulatory
This is a complete mess, by the way. I mean, but what I would not focus on is knowing all of it, because you can get lost in it. I would just focus on the layers and players. That's how I say it, right? So if you decide to work, I would start with the business problem. I would decide what you want to build as a creator. And then I think once you have that creator, and then the second thing is token economic system. Once you have those two, it becomes easier for you to solve the technical problem because you have the choices to say, what is a cheaper network? What options do we have? If I want to build this, then you can zero in on, let me go to 721 or 1155. And what's the equivalent of this in this ecosystem? So now you're not dealing with the complete mess of every single standard available. You're only tied to a standard that pertains to your project, if that makes sense. So I wouldn't worry too much about knowing everything, which is a mistake I did, and you can go nuts because there's so much to don't know in space. I would go down with what problem you're solving. Are you a creator? Are you creating an art? Are you creating music? Or are you creating a video? What does that look like? Is there going to be underlying decentralized storage? And then figure out and that's why I keep telling you, cannot stress this enough, over time, we all focus on technical stack, focus on token economic system. What is the sustainability of model? Who really earns? Who really spends? How do people acquire tokens? Which means that you could have an amazing project and you could have a beautiful token model, but if it's not listed, how do you attract ecosystem participants? Well, you need to have a token listed on some exchange that people can buy who are not participating in, but they want to be a part of your DAO. How do you facilitate that? The ease of onboarding common people. Because most artists that I met in NFT, they had no clue what technology is. It was a very colorful group, though. It was all creators. They were all abstract thinkers, all different color hair, which was fantastic. And but they were focused on creation. They focused on their own little world. Some of it I just I had no idea what they were doing. Like, they would not have no idea what we were doing, but it's a perfect match of tech and creators coming together in this cultural sort of mix. That is what NFT is all about, I think. So this is something which is by CoinDesk, and I actually had built this something similar, which I'll show you after this slide, for our fund. But this is an important part. So remember, you have computing, all the things that we talked about this morning, all those consensus mechanisms. So you have shared storage, oracles, private computing, shared network. There is a classification in CoinDesk now for computing, which is a very, 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 very big area, by the way. And so I asked the question yesterday, which is the largest traded instrument in crypto industry today? Why is that? Because you have to pay for these systems. You need money. To your point, what do you do with Bitcoin today, right? But you need to go buy computers. So this industry, and many of these industries rely upon that liquidity coming in because they still have to rely on, but to me it's a spectrum. It's a matter of time when people begin to accept Bitcoins, and that reliance on stablecoin will wean off. And I'm curious to look at that statistics year after year to see how much liquidity is coming in from the traditional finance, and at what point are we not reliant upon that liquidity. I would suggest you should look at that too, because that will be a telltale sign, regardless of what your neighbors are talking about, is where the industry is heading. And that'll be an inflection point when that happens. When stablecoin becomes like a stable, is, I won't say stable because stablecoin is meant to be stable, but the statistics is sort of static. It doesn't go up or down and eventually begins to wean off. That's my thing that I'm following on. Then you have currencies, you have DeFi, you have entertainment, smart contract digitization, and these are some of the examples of how the classification goes. It's a long, so the idea is not to go through and explain this. The idea is this exists, which was not the case 8 months back. So we look into investor self-categorization, which is what I have done. I'll share that with you. What's an asset? To your question, Niharika, what's a utility? What's a payment? What's a hybrid instrument, which means an instrument that can be used as a payment, also used as in-network currencies. ETH is a perfect example. And all the highly liquid assets are in this category.
Basically, payments is an asset.
Yes, and mostly we look at stable coins and Celo. Celo's trying to do a telco-based payment, like they're trying to marry crypto and what M-Pesa was all about. And I think what Paytm and RuPay is trying to do in India, but that's still a centralized system that's still reliant upon your UPI behind the scenes. But what if I could truly enable peer-to-peer?